Pension funds are panic buying. The $50 billion wave coming in January. Risk. Next week. The markets are quiet. Too quiet. While most investors are celebrating the holidays, something unusual is happening beneath the surface. Pension funds, the largest pools of capital in the world, are moving $50 billion. All of it flowing into the same assets. All of it happening in the next 7 days. This is not speculation. This is mathematical certainty. And when this wave hits, everything changes. The question is not if it will happen. The question is, are you positioned on the right side of it? Welcome to Financial Announcement. My name is Marcus Reynolds. I'm a financial analyst based in Chicago, Illinois. For the past 12 years, I have tracked institutional capital flows for a living. I study where the big money moves before it moves. I analyze patterns that most investors never see. Today, I am bringing you a story that demands your attention. If you value strategic financial intelligence, if you want to understand what the professionals are doing while the markets sleep, then you need to subscribe to this channel. Think of it this way. When you read the newspaper every morning with your coffee, you get yesterday's news. Here, you get next week's reality. So click that subscribe button. It costs you nothing. It could save you everything. Now, before we begin, I want to know, where are you watching this from? Are you in New York, London, Singapore? Drop your city in the comments. I want to see how far this information is traveling. Let us begin. The calendar shows December 26th, 2024. The trading floors are empty. The hedge fund managers are on vacation. The retail investors are enjoying the holiday season with their families. But deep inside the computer systems of the world's largest pension funds, something is moving. It starts quietly. A pension fund in California begins selling equity positions. Another fund in New York starts accumulating bond futures. A third fund in Texas places large orders for commodity ETFs. Individually, these trades mean nothing. But when Marcus Reynolds pulls up his institutional flow tracker, he sees a pattern. The same pattern he has seen every January for the past decade. Pension funds are rebalancing, and this year the numbers are staggering. Most people do not understand how pension funds operate. They think pension funds are like mutual funds or hedge funds. They think someone sits in an office and decides what to buy and what to sell based on market conditions. This is incorrect. Pension funds do not have that freedom. They are bound by strict allocation rules written into their charter documents. A typical pension fund might have a mandate that says 60% equities, 30% bonds, and 10% alternative assets. These percentages are not suggestions. They are legal requirements. If the stock market rises significantly and equities now represent 65% of the portfolio, the fund must sell equities and buy bonds and alternatives to return to the 60-30-10 ratio. This is called rebalancing. In 2024, the stock market performed exceptionally well. The S&P 500 gained over 20%. Technology stocks soared even higher. Meanwhile, bonds had a difficult year. Treasury yields rose. Bond prices fell. This created a massive imbalance in pension portfolios across the world. Marcus Reynolds runs the numbers. He estimates that the average pension fund is now overweight equities by 3 to 5 percentage points. This might not sound significant, but when applied to $50 trillion in global pension assets, it represents a problem. A 3% rebalancing on $50 trillion equals $1.5 trillion that must move from equities into other asset classes. Not all of this movement happens at once. Different funds have different rebalancing schedules. Some rebalance monthly, some quarterly, but the majority of large institutional pension funds rebalance annually, and the majority of those execute their rebalancing in the first 2 weeks of January. Marcus estimates that between $50 and $80 billion will flow out of equities and into bonds, commodities, real estate, and infrastructure assets in January 2025. This is not a prediction. This is a calculation based on publicly available allocation data and year-end portfolio positions. The interesting part is not just the size of the flow. The interesting part is the timing. Pension funds do not spread this activity out over the month. They concentrate it into the first 5 to 10 trading days of January. Why? Because they want to complete rebalancing early in the quarter to minimize tracking error against their benchmarks. This creates a phenomenon that professional traders watch carefully. In the first week of January, certain asset classes experience enormous buying pressure that has nothing to do with fundamentals, earnings, or economic data. The buying happens because pension funds are mathematically required to buy. Marcus looks at historical data. In January 2020, pension rebalancing drove a 15% rally in underweight asset classes within 30 days. In January 2023, the same pattern pushed precious metals up 12% in 2 weeks. The pattern is consistent. The pattern is predictable. And this year, the pattern is setting up again. But there is a problem. While pension buying creates upward pressure in January, it also creates a dangerous void in February. Once the rebalancing is complete, the buying stops. The institutional bid disappears. and the assets that rallied on mechanical pension flows suddenly have no natural buyer. This is the trap. January offers opportunity, February offers risk. The professional investor understands both sides. The amateur investor sees only the January rally and gets caught in the February reversal. Marcus Reynolds knows this cycle well. He has traded it successfully for years. But this year feels different. This year, the imbalance is larger, the flows are bigger, and the market is entering this period at all-time highs with record low liquidity. The next 7 days will determine positioning, the next 30 days will determine profits. And the next 90 days will determine who understood the cycle and who did not. The silent accumulation has begun. Claude is AI and can make mistakes. Please double-check responses. Marcus Reynolds sits in his office on December 27th. The building is almost empty. The coffee machine in the break room has been turned off for the holiday. But his computer screens are alive with data. He's not looking at stock charts or technical indicators. He is looking at something far more valuable. He is looking at the allocation reports from the largest pension funds in North America, the California Public Employees Retirement System, the New York State Common Retirement Fund, the Teacher Retirement System of Texas. These are not small players. CalPERS alone manages over $450 billion. When these institutions move, markets move with them. Marcus opens the quarterly allocation report from CalPERS. The target allocation is clear. 50% global equity, 28% fixed income, 13% real assets, 9% private equity. These numbers are sacred. They are written into the investment policy statement approved by the board of directors. Deviation from these targets triggers mandatory rebalancing. He pulls up the actual allocation as of December 23rd. Global equity sits at 54.2%. Fixed income has fallen to 24.6%. Real assets are at 12.1%. The math is simple. CalPERS is 4.2% overweight in equities. They are 3.4% underweight in bonds. On a $450 billion portfolio, this means they must sell approximately $19 billion in stocks and buy $15 billion in bonds. CalPERS is just one fund. Marcus repeats this analysis across the top 20 pension funds in the United States. The pattern is identical. Every major fund is overweight equities and underweight fixed income. The aggregate numbers are staggering. Across the top 20 funds, he calculates a combined equity overweight position of approximately $65 billion. Now comes the critical question, where exactly will this money flow? Marcus breaks it down by asset class. Fixed income will receive the largest allocation. Based on historical patterns, he estimates $25 to $30 billion will flow into bonds in January. But not all bonds are equal. Pension funds have strict credit quality requirements. They cannot buy junk bonds or speculative grade debt. They focus on investment-grade corporate bonds, treasury securities, and municipal bonds. Within the bond market, there is a hierarchy. 10-year treasury notes will see significant demand. Investment-grade corporate bonds from blue-chip companies will attract pension capital. Municipal bonds, especially from states with strong credit ratings, will experience buying pressure. The impact on yields will be measurable. When $25 billion enters the bond market in a 2-week window, yields compress, prices rise. Marcus shifts his focus to commodities. This is where the analysis becomes more interesting. Most pension funds maintain a 5 to 10% allocation to commodities and real assets. In 2024, commodities underperformed equities significantly. Gold started the year strong but faded in the fourth quarter. Silver experienced volatility but ended the year below equity benchmark returns. Energy commodities were mixed. He runs the calculation. If pension funds are targeting a 7% average allocation to commodities, and they are currently sitting at 5.5%, the gap must be filled. On a combined portfolio of $3 trillion across major pension funds, a 1.5% reallocation equals $45 billion. Not all of this flows into commodities, but a significant portion does. Marcus estimates that $5 to $8 billion will flow into precious metals alone. Gold ETFs will see institutional accumulation. Silver futures will experience buying pressure. Platinum and palladium, often overlooked, may see disproportionate moves due to lower liquidity. This is not retail speculation. This is institutional mandate fulfillment. Real estate investment trusts present another target. Many pension funds categorize REITs as real assets, not equities. In 2024, REITs underperformed the broader stock market. Interest rate concerns kept a ceiling on R8 valuations, but pension funds do not care about near-term interest rate fears. They care about allocation percentages. If the policy says 8% real estate exposure and the current position is 6%, they buy REITs. Period. Infrastructure is the final piece. Toll roads, utilities, energy transmission networks. These are long-duration assets that pension funds favor for their stable cash flows. Many of these assets trade in private markets, but pension funds also access them through publicly traded infrastructure funds and MLPs. Marcus estimates $2 to $3 billion in flows to this category. The breakdown is complete. $25 billion to bonds, $7 billion to commodities, $5 billion to REITs, $3 billion to infrastructure. The total exceeds $40 billion, and all of it must execute in the first 2 weeks of January. This is not random market activity. This is systematic institutional capital deployment, and it is about to begin. December 28th arrives with an eerie stillness. Marcus Reynolds checks the futures market. Volume is anemic. The ES futures contract, which normally trades millions of contracts per day, is moving only a few thousand. Spreads are wide. Liquidity has evaporated. This is the ghost week. Most investors do not realize what ghost week means. They think it is simply a quiet period when people are on vacation. They think trading slows down, but markets remain stable. This is a dangerous misconception. Ghost week is not stable. It is a liquidity desert, and in a desert, even a small disturbance creates a sandstorm. Marcus has seen it before. December 2018. A single headline about Federal Reserve policy during Ghost Week triggered a 5% market drop in 2 days. There was no fundamental reason for the move. There was simply no liquidity to absorb the selling pressure. By January 3rd, when institutional traders returned to their desks, the market recovered half the losses within hours, but the traders who panicked during Ghost Week locked in devastating losses. The mechanics are simple. In a normal market, if a large sell order hits the exchange, market makers step in. They buy the other side of the trade. They provide liquidity. They smooth out the price impact. But market makers are human beings. During Ghost Week, they are in the Cayman Islands or Aspen or the Swiss Alps. The trading desks are staffed by junior analysts with strict instructions. Do not take risks. Do not deploy capital. Just monitor the systems and call if something breaks. This creates a vacuum. When a sell order enters the market during Ghost Week, there is no institutional buyer to absorb it. The order hits the bid and the price drops. This triggers algorithmic trading systems. The algorithms detect downward momentum. They initiate short positions. The price drops further. More algorithms trigger. The cascade accelerates. Within minutes, an asset can lose 3 or 4% for no fundamental reason other than the absence of liquidity. The same dynamic works in reverse. If pension funds begin early positioning during Ghost Week, even modest buying pressure can spike prices. A $5 million purchase order that would barely move the market in October can drive a 2% rally in December. The algorithms detect upward momentum. They go long. The price accelerates. Retail traders see the move and chase it. By the time the move is over, the asset is overbought and vulnerable to reversal. Marcus marks his calendar. December 28th through January 1st is the danger zone. Any positioning during this period carries elevated risk. The smart move is to wait. Let Ghost Week pass. Let liquidity return, then execute. January 2nd marks the beginning of the real event. This is when the first wave of pension rebalancing begins. Trading volume returns. The institutional desks are staffed again. But the dynamics are still unusual. The first week of January typically sees 40 to 60% higher volume than the final week of December. This surge is not driven by new information or earnings reports. It is driven by institutional rebalancing. Marcus analyzes historical volume patterns. In January 2020, the first 3 trading days saw combined volume exceeding the entire previous week. In January 2023, the pattern repeated. Bond ETFs experienced their highest single-day volume of the quarter on January 4th. Gold futures spiked on January 5th. The pattern is consistent. But here's where the calendar becomes critical. The buying pressure is not sustained. Pension funds have a narrow execution window. Most funds complete their rebalancing between January the 2nd and January 10th. Some extend into the second week, but the majority finish early. This means the buying wave lasts approximately 5 to 7 trading days. After that, it stops. Marcus highlights January 10th on his calendar. This is the statistical peak. Historical data shows that assets driven higher by pension rebalancing tend to top out around January 10th. The buying pressure exhausts itself, profit takers emerge, the institutional bid disappears, and the assets that rallied 15% in 10 days begin to drift lower. January 15th is the next critical date. This is when the first cracks appear. Early buyers begin taking profits. Momentum traders exit positions. The algorithms detect the shift and reverse course. What was a buying cascade in early January becomes a selling cascade in mid-January. But the real danger arrives in February. Marcus pulls up data from February 2020, February 2021, February 2023. The pattern is unmistakable. In each case, the assets that rallied strongest in January experienced corrections in February. The average drawdown ranges from 8 to 12%. In extreme cases, the entire January gain evaporates by February 15th. Why does this happen? Because pension funds are done buying. The rebalancing is complete. The The allocations are back to target. There is no more institutional flow. The assets are left to trade on fundamentals. And in many cases, fundamentals do not justify the January prices. Marcus creates a timeline. December 28th to January 1st is Ghost Week chaos. January 2nd to 10th is pension accumulation. January 10th to 15th is the topping process. January 15th to 31st is consolidation. February brings the reckoning. This is not a prediction. This is a roadmap built from historical data and institutional behavior patterns. The calendar does not lie. The flows are mechanical. The risks are measurable. The question is not whether this cycle will play out. The question is who will be positioned correctly when it does. Marcus looks at the calendar one more time. 6 days until the wave begins, 30 days until the peak, 60 days until the reversal. The clock is ticking. Marcus Reynolds stands at his standing desk on December 29th. The sun has not yet risen over Chicago. The city is silent. His coffee is still hot. On his screen are 15 different charts, but he's not looking at price action. He's looking at a spreadsheet that contains the positioning strategy for the next 45 days. This is not gambling. This is not speculation based on hunches or technical patterns. This is strategic positioning based on institutional behavior that repeats with mathematical precision every single year. Marcus has traded this cycle for 11 years. He has made money in 9 of those years. The 2 losing years taught him more than the winning ones. The first rule is timing. Enter too early and Ghost Week volatility destroys the position. Enter too late and the pension wave has already moved prices. The optimal entry window is narrow. Marcus has identified it through years of backtesting. December 30th and 31st represent the ideal entry dates. Liquidity is still low, but the worst of Ghost Week chaos has passed. Prices have not yet begun the January run. This is the sweet spot. But what exactly should be bought? This is where most traders fail. They see that pension funds are buying bonds and commodities, so they rush into random bond ETFs or gold miners without understanding the specifics. Pension funds do not buy randomly. They buy specific instruments that meet their mandate requirements. Marcus opens his institutional flow analysis. He cross-references the allocation gaps with the most liquid instruments available for purchase. For fixed income exposure, pension funds favor the iShares Core U.S. Aggregate Bond ETF. This single ETF provides diversified investment-grade bond exposure. When pension funds need to deploy $5 billion into bonds quickly, they do not buy individual securities. They buy AGG in massive block trades. The analysis is clear. AGG will see significant institutional accumulation in the first week of January. Marcus calculates a potential 3 to 5% move based on historical flow patterns and current positioning gaps. A 5% move in a bond ETF might not sound exciting, but when executed with proper size and leverage, it becomes meaningful. For commodities, the picture is more fragmented. Some pension funds buy physical gold through allocated storage programs. Others use futures contracts. But a significant portion uses the SPDR Gold Shares ETF for instant liquidity and easy rebalancing. Marcus estimates that GLD will absorb 2 to 3 billion in pension flows. On average, daily volume of 8 million shares, this represents substantial buying pressure. Silver presents a more volatile opportunity. The iShares Silver Trust has lower liquidity than GLD. When pension funds allocate even $500 million to silver, the price impact is pronounced. Marcus reviews January 2023. SLV rallied 14% in 9 days on pension rebalancing flows. The fundamentals for silver had not changed. The buying was purely mechanical. Real estate investment trusts require more nuanced analysis. Not all REITs are equal in pension fund portfolios. Pension funds favor diversified REIT ETFs over individual property companies. The Vanguard. Real estate ETF is a primary vehicle. Marcus calculates that VNQ will see 4 to 6 billion in institutional inflows. On a market cap of 35 billion, this moves the needle. Now comes the critical decision. Should these positions be taken with cash or with options? Marcus weighs the trade-offs. Cash positions are safe but require significant capital. A $100,000 position in AGG might generate a $5,000 profit. Options provide leverage but introduce time decay and Ghost Week volatility risk. Marcus has developed a hybrid approach. He uses 70% cash and 30% options. The cash positions provide stability and guaranteed participation in the pension wave. The options provide asymmetric upside if the move exceeds expectations. For AGG, he plans to buy shares outright. For GLD and SLV, he will use call options with February expiration dates. This gives him 45 days for the thesis to play out. Position sizing is the next consideration. Marcus never commits more than 15% of capital to any single pension rebalancing trade. The cycle is predictable, but it is not guaranteed. Black swan events can disrupt institutional flows. A major geopolitical crisis or unexpected Federal Reserve announcement can override pension rebalancing dynamics. Stop losses are mandatory. Marcus sets them at 5% below entry for cash positions and 30% below entry for options. The stop loss for options is wider because short-term volatility can trigger premature exits. The key is surviving ghost week volatility while remaining positioned for the January wave. The entry checklist is complete. December 30th, execute cash positions in AGG and VNQ. December 31st, execute option positions in GLD and SLV. Total capital allocation is 40% of the portfolio. The remaining 60% stays in cash as dry powder for opportunistic additions or emergency exits. But entry is only half the battle. The exit strategy is equally important. Marcus has watched countless traders ride the pension wave perfectly, only to give back all gains by holding too long. The exit must be systematic and emotionless. January 10th is marked as the first evaluation date. If positions are up 3% or more, Marcus will sell 30% and move the stop loss to break even on the remainder. This locks in partial profits, while allowing for further upside. January 15th is the hard exit date for 50% of remaining positions, regardless of profit or loss. By January 20th, all positions must be closed. Why the urgency? Because February is coming. And February does not care about January gains. February is when the pension bid disappears. February is when profit takers overwhelm momentum buyers. February is when the trap snaps shut. Marcus has one more layer to his strategy: portfolio insurance. While he is long bonds, commodities, and REITs in January, he will simultaneously buy March put options on the S&P 500. These puts are cheap in early January when volatility is low and markets are calm. If the February correction arrives as expected, these puts will offset losses and potentially generate significant profits. This is the barbell strategy. Long the assets pension funds must buy. Hedged against the assets pension funds must sell. Positioned for January upside, protected against February downside. It is not perfect. No strategy is. But it is rational. It is disciplined. And it is based on institutional behavior patterns that have repeated for decades. Marcus saves the spreadsheet. The plan is set. The positions are sized. The entry dates are circled. The exit timeline is programmed. All that remains is execution. 6 hours until the futures market opens, 48 hours until optimal entry, 10 days until the pension wave peaks, 45 days until the cycle completes. The framework is built. The risk is measured. The opportunity is defined. Now it is time to execute.